I'm going to tell you exactly how I invest money for my clients. In today's video, I'm going to walk you through exactly how I think about that, but really how I do it. What are the main considerations when it comes to building an investment plan, an overall financial plan, and how I specifically view investing. Now, if you haven't checked it out already, make sure to see the video where I ask strangers about investing. I go in public and I ask people, what did they do to have a successful retirement? I do that so that I can share it with all of you so you get that feedback. How often do you get to go up to a stranger and say, hey, what can you do now that you couldn't do before because you had to work? And I've gotten some pretty funny responses, but also some helpful responses where people say, Ari, honestly, the biggest difference is I get to sleep in and I don't have to worry about going to work the next day, or I get to drink more Chardonnay, or you know what, I get to go on more trips and not have to think about, oh my gosh, I have work on the next week or the next month. They are done. So it's fun to hear from them of what they've found successful. It's fun to be able to get to share with all of you my client success stories so that you can understand how you can do the exact same thing. Never worry about running out of money, but not just never worry about running out of money, really optimizing your money. At the end of the day, I want to help as many people retire early, which if you've been listening for some time now, you know, it's not an early retirement that I'm in love with. What I'm in love with is knowing for you when you no longer need to work. If you love work, great, keep doing it. If you don't love work, when are you in a position where it's truly now optional? Where if you don't want to do it, you don't have to. But also know that part-time income can play a big role, and your health plays a big role. And so many of these factors come down to the following example, and I promise we're getting into the video, which is people don't look back on their life and go, Ari, my average rate of return was 9.7462%. No, they don't do that. They go, I had more time with family. I had more time with friends. Now, I love the nerding out, truthfully, of optimizing tax situations and saying you don't pay a dime more than you need to. I often say this on my podcast, Early Retirement. I'm all about being patriotic, but you don't need to pay a dime more in taxes than you need to. What you do need to do is optimize what you've worked so hard for. So I love helping people do just that, which, by the way, if it's not obvious, I'm a financial planner and I help people retire early. So how do I invest my clients' money? Well, first we go through an in-depth planning process and we determine how much money they need based off their individual situation. We understand not just, hey, what's your risk tolerance on a scale of 1 to 10? I hate that question, by the way, because to me, how could you even know? Are you a 5? Are you a 7? Maybe someday you're feeling good and it's an 8. Other days you're like, I'm a 4. That question can be okay for a conversation, but at the end of the day, it should be customized. Your risk tolerance should not be of how you feel one day. It shouldn't be a number. It should be customized based off of how much money you want to live off of, how much risk you're okay with taking. When I say risk, what is risk? Well, I invite clients to reframe risk a little differently because most people are aware of the first risk, which is the risk that you run out of money. And that's not fun risk. Well, how could that happen? That could happen if you have one stock, if all your money's in one position, and all of a sudden that's Blockbuster, or all of a sudden that's GoPro or Quicksilver, and it takes a big hit. Additionally, the other risk is purchasing power risk. What is the risk that over the course of time, your money loses value to inflation? That's what I care about. How do we protect your money so you never run out of money? And how do you not run out? You don't let your money get essentially a slower growth rate than inflation. So what I tell people is, yes, it's not fun when your money goes up and down in the short term. And if we go through a planning process and you say, Ari, I get it. The financials make sense, but I don't care because I don't sleep well at night knowing that's the way I'm invested, then we're not doing it. We're finding out what is the right mix for you because financial planning should not bring more stress. We often say financial freedom is really the freedom to think about money less, not more. That defeats the purpose. So the first thing I tell clients is really around education, which is if you could have a penny and that doubles every single day for a month, or $1 million today, which would you choose? And most people go, Ari, I'm clearly choosing the $1 million. And the financial answer is correct up until about day 27, where the penny actually wins and the penny makes more sense. And the reason for that is compound interest. And that is the first thing to understand, is that compound interest when it comes to investing money is the biggest thing that people don't consider. Now, it's not they don't consider it. They know that it's a thing, but they don't really understand the magic of it until they hear this next example. And here's why it's so important for you as someone who's thinking about retirement as opposed to someone who's younger. Check this example out. Let's assume that you get a 10% rate of return and you have, let's just say $10,000. Great, you made $1,000. Now let's assume that you have $1 million and you got a 10% rate of return. Well, you made $100,000. What changed in effort? What amount of effort or work or energy did you have to do? None. It's the exact same. Whether you had $10,000 or $1 million, you got 10%. So at the end of the day, what you can see here is that people stress out about how much more they need to keep investing when they get later into, or call it closer to retirement. Well, the reality is earlier in your career, it's really important to add more dollars, because you can see if you do a $10,000 contribution, you only have $10,000. Well, you've just doubled your money. Your 10,000 is now 20,000, and you got a 10% rate of return. Wonderful. It's $1,000. Once it's 20,000, it's now $2,000. But let's look at that same example over here now. Well, if you have $1 million and that doubles, it's going to take you a lot of time if you're contributing $10,000 every single year to get to $2 million, as opposed to investing really well, getting a 10% rate of return in 1 year, and that's $100,000. So it's less important to add more dollars to your retirement plan as you're in retirement, or nearing retirement, I should say. It's much more important to be invested really well and intentionally. Not saying you don't want to be invested well from an early age, but it's not as impactful because you're adding more contributions. That's the majority of the weight of what's bringing more value. I hope that resonates. If that does, please leave a comment below and I'll keep doing more examples like that. If not, go, Ari, I'd prefer actually if you explained it like this, or I heard you say this in a podcast episode and this resonated more. I'm always looking for areas for improvement. I want to help as many people retire as possible, and I want to do that as effectively as I know how to do, which comes with your help. So thank you for that. Now, going to my third point, there's no such thing as free lunch. And what I mean by that is you don't get to invest and not have any ups and downs along the way and say, I can't wait to see these amazing returns. Now, too many people, in my opinion, go, but I hear about all these people who get in early and all of a sudden they reap these amazing benefits. Well, that certainly exists, but there's also the alternative, which you don't hear about so often, which is when you put money into a single company and it doesn't perform well. In fact, it performs poorly, and now you missed out not just on the growth of that company because it didn't happen, but the growth of all of these other companies. So what I tell people is when it comes to investing in retirement, the way you win is by not losing. It's not about hitting home runs, but if you enjoy baseball at all, we're not hitting home runs for my clients. We are hitting singles and doubles, understanding that there are different market cycles, different investments perform differently during different market conditions. So we might have a ton of passive real estate. We might have a ton of international small companies. We might have emerging markets. We might have large companies that are here right in the US. But what I know is that the way my clients are going to win is not by trying to guess and say, this is the one piece of the market that is going to outperform all the others. What we do is we say, let's have an understanding of how do markets work, and then align our money to really almost put on the turbochargers, if you will, saying, hey, we don't know what's going to outperform, but we know that we want to live off of this income. So the way we're going to live off income in retirement is by having different markets performing differently and owning them. So if, for example, international small companies aren't doing so well, but domestic companies that are large are doing well, great, let's pull from those and live off of those. And then we know, because of the way markets work, when those don't perform as well, we can now have the international small companies and we can pull from those as well. So it's this act of saying, how can we always make sure there is some place to pull income from so that you can go ahead and take more time with family and travel? Or you can say, I want to go out to dinner more with my partner, whatever it is you want to do. Remember, don't get too lost in the investment weeds. That's what we love doing. It's what I nerd out over. But what I want you to do is don't lose sight on the overall vision. A lot of people will say, great, I love investing. It makes sense to me. But I also know that it just pains me when the market goes up and down. And so can I limit that? Well, yes, you certainly can limit that. So you can always limit the amount of what we call volatility, a fancy word for ups and downs. But that's going to mean that later in life, you're not going to see as much return. And that might be okay with you. You might go, you know what, Ari, I understand the finances. I've heard your examples, but I'm okay with that trade-off. Or you might go alternatively, you know what, I know that it's not fun. It pains me in the short term, but Ari has told me about purchasing power risk. He's told me about inflation and how that works. And at the end of the day, what you want to make sure you do is never run out of money. So how do you do that? You do that by outpacing inflation. And the best way to do that is you own the companies that increase their prices. The fourth thing here is understand the rule of 72. And if you've never heard of that before, well, I am jealous, because when I first heard about it many, many years ago, I was excited and it just resonated immediately. So I hope it does the same for you. And the rule of 72 states, if you take 72 and you divide that by your rate of return, that is how long it's going to take you to double your money. So let's assume that you have that 72 number and you divide that by 10%. 10%, the historical average of the S&P 500. Well, that tells you that it's going to take 7.2 years to double your money. So it's helpful because as you're thinking about, great, what can I reasonably expect from your portfolio? Well, that's just a basic rule of thumb that I actually do find is helpful, but you're never going to get exactly 10%. Maybe it's going to be 8%, maybe 9, maybe 11, maybe 12. The historical average of small companies is 12%. But then again, we can look at different markets and go, well, what if we started investing in 2000 or 2010? And that's what we do with clients to show them, here's why markets perform differently, and here's what we recommend so that you never run out of money. This is that exact portfolio. Now, we as advisors, we partner with great companies, but we are never compensated by those companies. So we don't receive any money from Fidelity or Dimensional Funds or Vanguard or any of these companies. The only way we receive compensation is by happy clients who see value, so it puts the impetus on us to provide that value. This one I'm going to tell you right now is not an official number, but it's an important statement. Understand that you do not know what's going to outperform or underperform, whether you are the most astute investor of all time or you've never looked at a textbook on investing in your life. The reality is you have an equal chance because no one knows exactly what's going to outperform next week. Just look at this most recent example. Right now, amidst global uncertainty, everything in Ukraine, everything in China, emerging markets are up 13.5% in the past month, as opposed to the S&P 500, which is up 8.5% as of this recording. So what's pretty wild about that is the fact that you don't know what's going to outperform or underperform. And the way that you win, once again, it's by not losing. The best form of offense truly is defense in retirement. The fifth and final thing here is it's going to be different for you and your neighbor and your best friend and your coworker. And maybe you love listening to podcasts and YouTube, and you'll hear all sorts of different things when it comes to retirement. And the answer is it's got to be customized. Whatever investment solution that you look at, it connects to your tax strategy, that connects to your overall investment plan, it connects to your withdrawals, it connects to your Social Security. Literally everything is connected, which is why if you don't do holistic 360-degree financial planning, we're just not doing it right. I hope this video was helpful. Please do like this video and make sure to subscribe for future videos so that you're always notified. Thank you so much for watching today's video. If you don't know, I am the host of the Early Retirement Podcast, and this is what I love doing. I help people create a custom strategy to retire early. You can always reach out to me or a member of our team here at Root, and we would be happy to walk you through our planning process to show you how we can help you get more life out of your money.